Hello and welcome to today's lesson. I'm your hard-working but indefatigable teacher, Mr. Burton. You will need to watch this video and take notes as you go. You may need to watch certain parts of the video a few times to ensure complete understanding. This is your homework and I will check your notes tomorrow before we get started. I hope you learned something.
Okay, hello and welcome to today's lesson. Today we move on to something different, a whole new topic. This topic is about balanced day adjustments, and we'll just introduce you to what balanced day adjustments are, and then we'll go into our first balanced day adjustment, which is bad debts. Right, balanced day adjustments are journal entries done on the last day of the accounting period, so that's typically the end of the financial year. Last day of the accounting period, the balance day. Now the reason for doing balance day adjustments is that they make the accounts more accurate. Period reporting. The life of the business is divided up into periods of equal length so that comparisons can be made. So we need to ensure that all transactions are recorded in the period that they relate to so that we can make a valid comparison between years or months or quarters. Valid comparisons of the financial performance and financial position of the business. And we've got another principle as well, accrual accounting. Transactions are recorded when they occur and not just when the money changes hands. So this means that we record transactions that have happened even if the cash hasn't been received or if we haven't paid the cash that we should have. So our main balance day adjustments are bad and doubtful debts, and this is when our accounts receivables go bad. Bad debts when we write off a component of the accounts receivable. There's a customer who owes us money, but we know now we're not going to get that money. Doubtful debts, we may or may not get our money. We're not sure. And the other type of balance day adjustment is depreciation. And this is where our non-current assets lose some of their value. So if a business owns a van, it's bought a new van, over time the value of that asset is going to depreciate. We need to record that, make an allowance for it, make an adjustment. Now here is the order which balance day adjustments come into play. So we've got transactions and we put them into our source documents. Source documents which are our journals and ledger accounts, and then we make our trial balance. Now come our balance day adjustments. We do these, our depreciation and our bad and doubtful debts, which will lead to an adjusted trial balance, and then finally our financial statements, our income and balance sheets. So what are the functions of balance day adjustments? Firstly, to adjust the value of income to the income that's been earned and the value of expenses to the expenses that have been incurred. And secondly, to ensure that the value of assets and the value of our liabilities are not understated or overstated when we prepare our balance day accounts, our final accounts. Okay, balance day adjustments, and here is our first type, bad and doubtful debts. So what we need to pick up today, we need to be able to create an allowance for doubtful debts and then prepare the relevant extracts of the income statement and then the balance sheet. Sounds easy? We'll see. Right, bad and doubtful debts. A bad debt is an expense that a company incurs when it sells goods or services but receives no payment or just a partial payment.
Bad debt expenses are debts a company incurs when it sells goods or services but receives no payment or partial payment. These expenses are part of conducting business on credit and occur for several reasons, including fraud, trade disagreements, or a customer simply evading the obligation to pay. Frequently, it happens when a party goes bankrupt. For example, a customer declares bankruptcy and cannot pay the contractor who had just finished building a deck in his backyard. The contractor will enter the bad debt on his income statement under non-collectible accounts. An equivalent amount is credited to what the business allows for bad debts. The contractor may not end up writing off the entire bad debt expense, however. Bankruptcy proceedings may enable him to collect some of what the customer owed. The use of credit helps a business increase sales. The possibility of taking on some bad debt expenses should not deter a business from selling its goods or services on credit.
Right, accountants need to ensure that the value of the accounts receivable isn't overstated in the balance sheet. So if the business has got bad debts, then the value of those accounts receivable is going to be higher than they are in reality. So accountants will make the adjustments by writing off bad debts immediately, and also by allowing for those debts which are deemed to be doubtful. Bad debt, an account receivable that's never going to be collected. The debtor is never going to pay. Doubtful debt, an account receivable that might become bad in the future, and the likely amount that the debtors will not pay. So they may pay some of it, but not all of it. Now, bad debts and doubtful debts are administrative expenses. So remember that. Bad debts, doubtful debts, administrative expensive. Classified as AE as you work your way through. When we're allowing for doubtful debts, the accountant doesn't know which debtors will not pay, and that means that the accountant's going to make an estimate of the amount. Accounts receivable can't be credited because we don't know which debtor won't pay. So an account called allowance for doubtful debts is credited, and this is a negative asset. So remember that an allowance for doubtful debts is credited, and that's a negative asset, as it is going to decrease the value of the accounts receivable when we come to do our balance sheet. Accounts receivable is reported at its net realisable value, i.e. what will be collected. So here we have our current assets, and within current assets there'll be an accounts receivable, and we'll have a little note there. Notes to the balance sheet. Accounts receivable would be $28,500 before allowing for our doubtful debts. Then we subtract the allowance for doubtful debts, in this case $4,700, which gives us our accounts receivable figure, which we'll report in the balance sheet with the note accompanying it. Let's have a look. Let's do a worked example. Bob the Builder, accounts receivable balance of $20,000 at 31st of March. Based on past experience, 5% of that amount will be uncollectible. So over the previous years, on average, about 5% of the accounts receivable balance is unable to be collected, and that's going to become our allowance for doubtful debts. So your question, prepare the journal entry to create an allowance for doubtful debts. This is what it looks like. In the general journal, we've got our date, and the date is the end of the balance period. Doubtful debts goes in. 5% of $20,000 is $1,000, and it's a debit. The allowance for doubtful debts is our credit. Double entry, balanced, and then the narration to create an allowance for doubtful debts at 5% of accounts receivable. Same scenario with Bob the Builder. The accounts receivable balance, 5% will be uncollectible. This time we are preparing the extract from the financial statements to show this. The income statement In the income, we have income statement, we've got our income and we've got our expenses. In the administrative expenses part of the income statement, remember we're just showing a little snapshot here. We know all about admin expenses from what we've done previously. So here we've got another administrative expense, doubtful debts, that $1,000. Pretty easy. Same scenario. And now our financial statements to show this. In the balance sheet, we have got our current assets. And within our current assets, we're going to have accounts receivable. And when allowing for doubtful debts, we're going to create a note and put our accounts receivable less that allowance for doubtful debts. So we have a little note on the balance sheet looking like this. Accounts receivable, $20,000. That's given from the information above. Less that allowance for doubtful debts, which is calculated at 5%, which is $1,000, giving a value of our accounts receivable which more accurately reflects the true amount that the business expects to collect, $19,000.